Hello, friends. My name is Rajeev Shah. I welcome you all to this webinar on the future of valuation and the uncertainty and challenges that all of us face while doing valuations. While this seminar or this webinar is not aimed at valuation professionals, but to larger users of valuation, private equity funds, banks, financial institutions, corporates, auditors, and all the people who use valuations in their daily life. I have, if I can begin with a brief introduction of myself, I'm Rajeev Shah. I'm the Managing Director and CEO of RBSA Advisors. We are a valuation firm. I think that's a good enough introduction for me. But I have very, very illustrious and eminent speakers with me. My colleague and friends, I have great pleasure in saying that they are my colleagues, my friends, my partners, all of it. We have people, two of the very finest brains in valuation across the world. I am in awe of their technical capabilities, and I am genuinely highly impressed by their valuation capabilities. And I am also proud of the ethical standards that they bring to the profession. We have with us PJ Patel, who is the co-CEO of Valuation Research Corporation, one of the largest valuation firms in India, valuation firms in US, I beg your pardon. I believe if there are top 3 firms, PJ would figure very much amongst there. The VRC would be very much there. He's an eminent speaker on valuation issues in US. He speaks and chairs many committees, including Appraisal Issues Task Force, Appraisal Industry Task Force. He's a well-known authority and an eminent speaker as long as valuation issues are concerned in US. He has spoken and conducted valuation, I think, across more than 40 countries in the world. And he's the co-CEO of VRC, which is one of the largest valuation firms in US. He's a partner, a friend, a mentor. I look up to him on many matters. And VRC is known for doing one of the finest and most complex valuations in US. We also have with us, again, my friend Ravishu Shah. I and Ravishu go a long, long time back. I think we began our career practically at the same time. And again, if I have to, I always use, and I say it to him, that if I have to go to a war on valuation, I would rather have you by my side. And he's a very, very eminent professional himself, more than 23 years of experience. He was an executive director or a partner with PwC in their valuation team for a long time. Spent almost 18 years with PwC, 4 years with Holcim SEC, and now he leads our financial advisory and valuation practice. Ravishu and PJ, welcome to this webinar. Thank you very much for sparing your time. I would love to act here as a student of valuation. I'll ask all the stupid questions which I can, and I was always afraid to ask. But let me ask these questions in a public forum, because I'm so foxed up with what's happening with the valuation industry. And PJ, for the benefit, there are maybe 80% of the delegates are from Indian subcontinent or this region. So we'll bring a lot of India to this conversation, and we'll pull you from US into this direction. But folks, we have tried to structure this conversation into 3 parts. One is focused on the challenges and the technical issues which a valuation professional or a user of valuation would encounter. The second part would be the trends that we foresee in the valuation profession as such. What's happening and what's likely to happen in valuation profession, and what would impact all the valuation professionals as all of us are. And thirdly, obviously, we'll take questions and we'll open this forum to whatever questions that we have. Beginning with the first part, and I wanted to start with a rather open-ended questions to you, PJ, and then to Ravishu. That today there is so much uncertainty in the markets. and no one has a clue of what kind of multiples or what kind of discount rates or what kind of future projections that we have. The whole theory of valuation, which gives us some predictability, is under test. How, and that's an open question, what are the challenges that you see as a valuation professional when we are doing complex valuation of large companies, where it is difficult to predict cash flows, difficult to see future? So what's your take? What are the challenges, PJ?
Yeah, first of all, Rajeev, thank you. It's a pleasure to be here, and really looking forward to our conversation, and really enjoy our relationship as well, both at a personal level and at a company level as well. So it's a very difficult time to do valuations right now. We find that probably, I've been doing valuations for 25 years, and I will say over the last 3 months, I've really had to think about how I do valuations. We typically have, used the standard approaches, income approach, market approach, transaction approach. But as I've said many times over this time period, my crystal ball is very foggy right now. It's hard to see what the future is going to look like. One of the approaches that we've started to use much more frequently is something called calibration. And so because it is so difficult, and quite frankly, at least in America, and I imagine it's the same in India, your valuation today might be very different than your valuation tomorrow. The markets are very volatile. The uncertainty really changes significantly from day to day. And so what we've tried to do is look back to some period of time. It might be 12/31/19, it might be something in the fourth quarter, or even early in the first quarter of this year, where we can really put a stake in the ground, where we know that we're comfortable with what the value of a business is. And then we say, okay, now that we have that, let's adjust the valuation for the uncertainties that we see today, and it may be a simple discount. The markets maybe have declined in a particular industry by 10%, and so okay, we have an idea of where the target value is. But we also are doing a lot of work, sort of on a bottoms-up basis as well, and when we look at forecasts and trying to understand what kind of recovery we can expect. Is it a V-shaped recovery, a U-shaped recovery? Is it something different than that? Just this morning, I was looking at the Sensex to see, what the shape of the recovery looks there, and it's hard to tell. Is it V-shaped? Is it U-shaped? Is it, going to be a check mark? So we're trying to triangulate. I think we'll hear that a lot as well. Is trying our best to get, have a stake in the ground, but also to look at market indices as best as possible to try to understand what the future might look like.
Ravishu, your take on this, how do you see, what are the challenges that you're facing?
So valuation has always been challenging. So because of the subjectivities involved, and in the heightened time of uncertainties, the volatility increasing, significant implications happens in terms of how do you perceive future, how do you perceive value. So the approaches which we typically use are the market approach, income approach, asset approach. Once again, significant difficulties in terms of how do you pursue future cash flows. What sort of a discount rate you would wish to apply given the uncertainties involved? If you're looking at the market multiples, are the current market multiples reflective of what one would wish as maybe the inherent or the intrinsic value of the business? How relevant are the transaction multiples given the passage of time and the current environment? So all this poses significant challenges in terms of putting a value onto the business or an asset. I think importantly, I fully echo what PJ was mentioning in terms of trying to triangulate the values through multiple approaches. The triangulation is always important in valuation, and more so important in this kind of a volatile period. If we are doing the income approach, we also see what sort of a sensitivity analysis or scenario analysis we try and do for the key variables. None of us necessarily know that whether the recovery will be V-shaped, U-shaped, W-shaped, but at least have some sort of a sensitivity analysis in terms of what sort of a difference it is making, and then trying to see how comfortable you are in terms of opining on a overall value outcome. So that's how we deal with it.
But Ravishu, and when I look at, there are several reports that even the management today, who normally used to give a quarterly guidance or some sort of guidance for future, even the management themselves are saying that we are not in a position to predict future. People who are running the company, and sometimes our regulators say that you as valuer should be able to take a view on that. Now, how does that work? Because if the people who are running the business can't do it, how PJ and Rajeev and Ravishu will do that? So that is baffling me. So PJ, what's your take on that? There's no predictability.
Yeah, you're right, Rajeev. It's very difficult, and what we have seen is there are probably an infinite number of scenarios. Even if you take, let's say a V-shaped recovery, over what time period? And how low does the trough go? It's difficult to know, and of course, as Ravishu mentioned a minute ago, we've seen all kinds of articles to say that it may be a U-shaped recovery or W-shaped recovery, or maybe no recovery. Maybe it's L-shaped. And so what we have tried to do is put together scenarios, and as best as possible, try to benchmark to the market. I think market expectations are always helpful to reconcile with, and again, I would look at if I were doing valuations in India, I would look at the Sensex and I would look to see, what does that look like? It looks like it's about 20% off its peak. That's one of the ways I would look at it. I would also look at industry data as well, and I think looking at industry data can be helpful to see, are there differences? Of course, there's going to be differences between travel and tourism and technology companies in terms of recovery. So as a general rule, I like to benchmark to the market wherever possible.
What's your take, Ravishu?
So if as a valuer, we also have the option not to do the valuation or not to use the income, I would have preferred doing it. But if we don't have the option, and we don't have the option of not doing the valuation, because assessment is required, more so in a volatile period. I'll go back to the basics in terms of what's a value and what creates a value. So inherently, it's a cash flows which creates the value, and certainly there are uncertainties in terms of prediction of the cash flows. Can I wish away the future expectations? I would certainly not want to do that. To the extent possible, I'll look at the DCF, and this is once again not to look at DCF in isolation or the income approach in isolation, but as a corroboration to the market, because as PJ said, that market you cannot wish away, and market over a period of time, I mean, one as a valuer will want to assume that the market over a period of time reflects the fair value of the assets. But where what cash flows help us to analyze is that what sort of an impact it should have on a valuation per se under various kind of scenarios. So if there are structural changes which may happen in a particular industry, let's say airline industry or maybe the restaurant industry, where the issues may be more structural, the future cash flows may be much more different as compared to the past. There could be certain industries where it would be maybe more of a temporary phenomenon, let's say like a power or a road. We were recently doing a valuation of a power entity for the purposes of impairment. and it's a significant proportion of it was guaranteed through a PPA with a reasonably robust payment security, availability-based tariff, pass-through fuel, and a limited dependence on the merchant tariff. So over there, the thought process was that maybe the issues would be more temporary as compared to a permanent erosion in the value. And certainly one did do a sensitivity in terms of what happens if the demand doesn't come up by 20%, 15% for next 1 year, 1.5 years, 6 months, and you look at the sensitivity to get a sense of what sort of a value erosion happens. So the scenario analysis, sensitivity analysis becomes more and much more important in terms of trying to have a sanity check between the multiples, market multiples, transaction multiples, as well as the income-based approach. I mean, the triangulation and the sanity check becomes much more important in this kind of uncertain times.
Rajeev, maybe I could just add one or two things there. Yeah, and Ravishu, you made mention of some of these things. I think it's very important that the qualitative aspects of the valuation are also very important. I think as we think about companies today and doing valuations today, in comparison to 3 or 4 months ago, we know that risk has increased. We also know that profits have decreased. And sometimes, it can be forgotten, especially when you see it in America, that the NASDAQ is at an all-time high, higher than it was in February. When you look at where the S&P 500 is, we're maybe 10% off the peak. And there's a lot of other factors that are going on there. Monetary policy for the various governments, the amount of liquidity that's available. Some of these things I think can skew the market a little bit, and so I think it's a challenging time to do valuations, and there's a lot of moving parts. We also really need to think about typically when we're doing a valuation, we're using market prices as of a single day. The market is so volatile, and so the value today, or the multiple today, is different than the value from yesterday. And so we have looked at averaging, we've looked at prices over a period of time, and we've also thought about something, and I don't know if this is a material issue in India, but in America we have something called control premiums. And so the idea that, the price at which a company would go private would be greater than, its current trading price. And we did a study on that aspect as well, and what we notice is that when a market is down, control premiums go up, and when a market is up, control premiums go down directionally. They're very simply put, but there is a relationship there between control premiums and changes in the market.
I agree with you, PJ. Again, PJ, we are facing right now, we have what we call an impairment season. Right now, we have a time where you have financial reporting, year-end report. A lot of companies are looking at impairment. Now, my colleagues come and ask me, this is the cash flow. Now, how do we judge whether this is just a temporary disruption or there is a permanent diminution in the value? And how is there a way what is the way that you would differentiate between a temporary loss or whether it will never come back again? Whether airline is a temporary blip or it is going to be a 5-year phenomenon, I have no clue. So how would you maybe take a qualitative view on this temporary versus permanent diminution thing?
Yeah, I think what we have seen here is that the view has been that it is temporary, at least initially. Now, I think that's directly relating to impairment. I think when we think of valuation, especially in the early days of COVID-19, on certain days you may think it's short term, other days you may think the world has now changed and it may never come back to the same. So from a pure value standpoint, I think we do at times and have at times thought that this might be a more longer term impact. Of course, when you're doing impairment testing, you have a deadline, year-end financials that that we need to think about, and you really have to make a judgment on what is appropriate. And so because of that, what we have seen is again, the scenario analysis. I think that with hindsight, you're likely to be wrong. No one's going to be able to know exactly what the future looks like. But what we try to do is, again, layer the qualitative factors in with the quantitative. We know that risk has increased. We know that profits have decreased. Now, to what degree have profits decreased and for how long? We don't know. So we run scenarios, and then we benchmark to the market as much as possible. We look at indices, for better or for worse. I think that despite all of the government intervention in the markets and things of that sort, they are an indicator of what future expectations are. And so we try to balance all of that. Now, I will say here, what we have seen is that outside of travel, tourism, hospitality sort of industries, and retail, impairments have been very limited. We have not seen a lot. But I am expecting that to change later on this year.
But if I look at an Indian context, many of the industries, real estate, retail, hospitality, there's a deal of uncertainty if and when they will bounce back. I mean, anyone can take a view whether it will take 2 years or whether it will take 6 months, and every one of us can be wrong. What do we take into it? How do we differentiate between permanent changes which are happening and cyclical changes which will reverse itself?
So, I mean, a difficult question, Rajeev. So it's once again, how do you forecast the change in the current behavior and the profitability? From an impairment testing perspective, once again, it will depend on the industry in which the entity is operating. Some of the industries are positively affected. So I mean, we were doing a valuation of an e-commerce company recently, and where the client believed that the valuation should be positively impacted because the conversion from offline mode to an online mode would accelerate because of the COVID. We are doing currently a valuation of an entity which is supplying vials for a pharmaceutical entity on a global scale, and they once again believed that their demand should pick up if the vaccine arrives and all those things, because the demand could significantly. It's a global supplier. We were doing a valuation of a road asset recently, and where the traffic forecast provided a couple of scenarios in terms of what sort of a V recovery or maybe a slightly longer V recovery or a U recovery for us to help take a call. Currently, another thing is, so it depends on the industry in which it is operating and whether you see a structural change in the behavior of the consumers going forward, or it's more of a temporary. If it is temporary, then how temporary is a qualitative judgment, and you need to look at many other factors, including the market, including the government intervention, because it's not a free fall, because you'll always have a policy intervention either by the central bank or the regulate. I mean, in terms of ensuring that there are no structural shocks which happens, or at least to mitigate the impact of structural shocks. So
coming to this policy intervention, now this is a favorite thing which I genuinely wanted to ask you upon. Now, policy, there is so much money being printed. There is so much government action, there's central bank action in US, in Europe, in India too. Now, that has all propped up asset prices, and today practically we are at a level which is, the markets are telling that COVID has not happened practically in US. I mean, they are past it. And if you look at the ground situation, most businesses are bleeding. Now, there is so much disconnect between these two. Now, if I were to be futuristic and if I say that market is forward looking, but how true is that? Because market could be extremely volatile. It has been propped up by easy money, zero interest rates. Now, the multiples that we are witnessing today, are they reflective of the intrinsic worth of business? So my question, I mean, these are open-ended questions in the sense that, are we valuing the intrinsic value of a business, or doing it benchmarking based on the monetary policy, because all our valuations are outcome of monetary policy, fiscal policy, and the manipulation which goes on by the governments themselves. Now, if that is the situation, your market approach, it's also in some sense corrupted. What's your take on that?
Yeah, very, very interesting, Rajeev. I think the headline is, as you spoke, as I spoke earlier, the markets are very close to where they were prior to COVID. And so in some ways, if you look at market expectations, you think that we're beyond COVID. But the reality is, when you look at other metrics, we value a lot of debt as part of our firm, and what we noticed there is initially yields were up 100 to 200 basis points. Today they're up 50 to 100 basis points. So as I was talking about earlier, risk has increased. When you look at the equity risk premium, this is a little bit difficult, but with Professor Damodaran, who I know presented with you not that long ago, he's got a forward-looking ERP, and in December that forward-looking ERP was just under 5%. I think as of April 1st, it was maybe 6.8%, but that's also come down to maybe 5.5% right now. But of course, that in some ways is based off where the market is at. So I think that it's difficult. I will also say one other metric. We work on transaction with private equity, and what we have noticed is that the multiples that private equity firms are paying have declined a little bit, 1 to 2 times EBITDA. So if there were deals that were being done at 10 times EBITDA, today they're being done at 8 times EBITDA or 9 times EBITDA. So there is some evidence that companies are not quite as valuable today as they were before, despite what the public markets are showing us.
What's your take, Ravishu?
I echo PJ's thoughts on that. Coming to the EBITDA which he referred to, which EBITDA? I mean, the question comes is which EBITDA? I mean, is it current EBITDA? Because current EBITDA may not be representative of it. It would have possibly significantly affected by the COVID. So how do I decide EBITDA on which I need to apply the multiple? Is it a normalized EBITDA? How do I estimate a normalized EBITDA? Do I look at past? Do I look at future? Or do I look at somewhere in between? So these are another questions in terms of application of or uncertainties involved on the valuation side, that the valuation has certainly declined. Maybe you believe that the markets are over enthusiastic about the future as compared to maybe the ground realities, and maybe the only time can tell. I mean, whether the market has overshot the underlying fair values or it is what it is.
But then won't our valuation, which is essentially dependent on market, be wrong to that extent? Because when I speak to my bankers and regulators, they tell me, give me that fancy idea of intrinsic value. So I tell them, see, I am a small man, I'm a student of market. They said, no, your valuation should be so perfect that it should be better than the market. Even God is not better than the market. Now, see what to do in that situation, because they have a very ideal theoretical idea of intrinsic fair value which a perfect valuer should deliver. Now, I do not know, we encounter such things in India when we speak to regulators and the bankers and the institutions. They somehow have that a notion that the valuer should arrive at a perfect number, and where the whole market is dependent, the whole basic data on which we rely upon is influenced by all these factors. So how do you encounter such situations in US, and what's your take there?
Yeah, Rajeev, it's difficult. I think we do our best to organize the valuation in a way that it makes sense to all of the stakeholders. And I think the idea of intrinsic value, that's much more aligned with a discounted cash flow analysis. But there's more uncertainty today in putting together a discounted cash flow analysis for even the most mature company. The things that used to be quite easy to do. But it is something that we try. We use scenarios and do our best to come up with values. I think we also look to, as I said earlier, we look to the market, but maybe it's not the market on a single day. Maybe it's the market over a week or 2 weeks or a longer period of time. So you have some sort of stability. And similar, the transaction approach is also something that's quite challenging, because is a transaction that was done 6 months ago even relevant today? It may not be. So there's a lot of negatives. There's a lot of the things that you need to overcome. But as I said earlier, I think Ravishu said the same thing, is we're going to triangulate. We're going to take all of these different dots, and maybe the dots are further apart than we're used to seeing. And we're going to try to make sense of that. And part of making sense of that is to look at control premiums, because I think that, the income approach, again, is much more of an intrinsic value sort of approach. And let's say you end up with a premium over the market, even a normalized market, maybe you can rationalize that with a control premium. And so values of companies, I think, do move more slowly than the market, than the prices of the market. So the prices may drop further more quickly than what intrinsic value is. So we're trying to rationalize it, but in the end, I think what I find is benchmarking to the market. In the end, you've got to be able to reconcile, what is the value of the company relative to where the market is at, regardless of what the situation is in the market, whether it's influenced by monetary policy or not, and other things. So that's the guiding principle for me, is reconciling to the market, making sure that relative to the market, we can understand what the right value is.
Ravishu, your thoughts on that?
So on that thought, intrinsic value also is not something which is a static number. So intrinsic value also moves with the time. And in case if there are certain structural changes or certain external environment changes in the external environment which affects the business, the values do get affected. In the times of higher uncertainties where we are, I mean, it is very difficult to estimate what's an intrinsic value of the business, because essentially, as PJ rightly mentioned, it is a cash flow driven value. But in a cash flow driven value, what we are essentially trying to do is forecast the future. And there is a risk both in terms of forecasting a future as well as in terms of what sort of a discount rate one would wish to use. So it's a interesting times we are living in. And in our thought, the value would go around a range rather than a particular number. So is that range a narrower range or a wider range? It is maybe more wider as compared to what we would have tried to give it in the traditional times. But we would end up using multiple approaches and trying to triangulate the value, and hopefully it remains within a band which you are comfortable with. And it would be an iterative process, because quite often it happens is that having done a particular valuation or having assumed a certain things in the multiples or the market approach or in the income approach, once you look at the outcome, it may not necessarily make sense to you. You go back to the drawing board and challenge yourself with some of the assumptions. So the number of iterations has increased. The rigor which is required in the valuation has increased as compared to what we have maybe used to in the past. And in the same breath, the valuation range also has increased.
Again, let me bring both of you to a more, maybe a different asset class. I mean, I understand all three of us do financial, but I wanted to have your views on a different asset class, which is real estate. Now, in India at least, we are witnessing a time where the buy-sell spread is very, very wide. And the depth in the market is virtually non-existent. So there are not many transactions happening. or the transactions which are happening are not representative of the, you can't build a confidence over the because the number of transactions are so little. Now, we, in majority of the asset class other than the liquid markets, we are not just looking at a level 3 value, we are probably looking at level 6 value. It is not level 1, 2, 3 are non-existent. We are talking about level 5 or 6 kind of illiquidity, kind of buy-sell spreads. Now, in that situation where there's so much, is the market, if the transactions are happening, are they representative of the value? I don't know. There are so few transactions happening. Can you build your thesis or your logic around it? We don't know. So in that situation, now in this uncertainty, now people like us have to go and value a real estate. And everyone is scared what to do and how to do it. How would you go about it?
Yeah, the tough questions, Rajeev. It's very difficult. I don't do a lot on the real estate side, but one of the things I will say, and this applies to businesses as well, is that you can only buy if somebody's looking to sell, and you can only sell if somebody's looking to buy. And so the range between buyers and sellers is quite significant, and I would expect it to remain quite significant. I think on the real estate side, I think we're also seeing issues around on the commercial side, is this work from home setup here to stay, and we're not planning on fully opening our offices at least until September. And quite frankly, it may be until January of next year. And even once we do that, I think what we have found is that people can work effectively from home. The technology is there. You look at this platform, you look at other platforms that are out there, they work very well. And I can say, even for myself with my role, I connect with people online like I would in the office, but I'm doing it virtually now. So it's there's a change in the environment, and maybe that change is going to stay. And unfortunately, it'll take, especially in the real estate side, it's going to take a while to reconcile between that. And I think you have other implications as well. And real estate tends to be more highly leveraged and less equity. And so now what happens when you're selling that property for below what the mortgage is on the property? It becomes very difficult. So I think it's something that may take a long time to reconcile and resolve. And I think we're still in the very, very early stages of that reconciliation. And quite frankly, at the point right now where there's market dislocation between buyers and sellers.
So what's your take on this market dislocation, Ravishu? In real estate, I'll add one more complexity for you. In India, we have the whole issue of the unaccounted cash. So there's that one more large angle, which is over and above the complexity that you already have.
So Raju, my answer is simple, that I'll flip the question to a real estate expert, which is you. So I'll flip the question to you, being a registered value real estate
answers, Ravishu. Honestly, there are no right answers. It is very, very difficult to make sense of the market. And my heart goes out to all the poor valuers, my brethren, because the market does not have any depth. The quality of data available is very, very poor. Whether the quality of data can be relied upon is highly questionable. While there is some degree of reliability in corporate real estate, office real estate, where there is more sanctity of that data, but when it comes to agricultural lands or essentially land markets, there is a wide gap between the quality of data, the quality of real estate, real transaction, and the fact that there is no depth in the market. We can quote whatever price that we want to quote. Are there any takers? If you reduce price by 20%, are there any takers? If you reduce price by 40%, are there any takers? There are no financiers. So therefore, the value is quite academic by that sense, because there is no evidence in the market to prove it or to disprove it. Now, in that situation, all the poor valuers, my brothers and sisters, they are going to face and have a difficult time, and they would better do a more thorough job and refrain from doing engagements where they cannot build up a case for doing them. That's my take on that. But again, so all the asset classes, PJ, are facing very different kind of challenges. At least in India, the real estate is passing through a very significant dislocation.
Yeah, it's very similar here, Rajeev. I think it's very difficult to have a crystal ball and understand what the impact of COVID is going to be. I recently read something where they said, COVID is not a change agent, but it's an accelerator. And the things that we're seeing, people working from home, working remotely, even the impact on certain industries. These changes were inevitable. They just happened much more quickly than we all expected. And so I think that's an interesting view.
One more question to both of you, and I just wanted to have your views when what we call there is a phase change in the market. We had that in 2008. We have it in COVID, when the market suddenly gets dislocated. So all the valuations done during that time or just prior to that. So if you had done a valuation, you had done a wonderful market approach and you had multiple transactions to go by, and there is a sudden phase shift and the market gets dislocated. What is the kind of risk we as valuers are exposed to in such a market dislocation? Because people are financing, investing based on our opinions. And one fine gentleman told me, but you are expected to know all that. You are expected to be able to predict all that. Now, how do I do that? So what do I reply to him?
Again, Rajeev, I would say here, I mean, my view is benchmark to the market. I mean, that is, sort of my guiding principle. I think certain elements of the valuation can be very subjective when you start thinking about cash flows and discount rates and growth rates, and very small changes can lead to very big value differences in some cases. And so, I think over time, over my career, what I have found is that by benchmarking to the market, you may be wrong in the end, but you're reconciling to the market. And I think there's an understanding, even in hindsight, people can understand how you came up with your values.
But again, the same people can ask us, you should know the intrinsic value. You could have done a DCF and come up to a very different number. Yeah. I mean, and that we are witnessing in all these startups, the WeWorks and all the SoftBank issues that we have, they invested in all these large companies, and they were there is a step-up investment going on to achieve a certain value. Now, when the music stops, everything comes cascading down. So, is this the world of these private markets and private equity markets are a real representative of value?
Well, that's difficult. I mean, there's so much more involved, with all of those investments. They're part of the market for sure, and I think that their view on value is reasonable. In the U.S., these private investors, in many cases, are doing more deals than anybody else. It's that they're very active, and I would also say even very well positioned as we think about the next 6 months in terms of recovery. It would seem that private equity in particular, they have capital and availability to do transactions, and so they're part of the market, and I think they do have a big influence on market pricing.
Ravishu, any thoughts?
You would so from my perspective, we would not be able to wish away the transactions in case if you believe that there are any other peripheral issues to the transactions which require you to look at it more closely than other, you would certainly do that. But if a transaction is happening in the recent times, or maybe in an earlier time, but with an adjustment for maybe the market uncertainties, you would not be able to wish it, because that's a price which somebody has paid post negotiation. So
very well.
Rajeev, I would just add one other point on that, is that I think historically when we've thought of private equity buyers, they did look at value much more from an intrinsic value approach, and really tried to, as they were doing deals, it was really on a risk-adjusted basis. They were acquiring companies, but today, just given the amount of money that's in the private equity markets, and the competition that's in that space, and their requirement to really do deals, we are seeing them, maybe being, more proactive than they've been in the past, and doing deals maybe at higher prices as a result of that.
Okay, just now coming to the second part of our conversation, how, and I would request maybe Ravishu also to join in here, how all this impacts a valuation profession. Because I understand the risk, a professional risk, professional liability risk, which all of us would face, would increase many folds. What's your take on this? And Ravishu, maybe you would like to lead this part of the conversation.
So Rajeev, I don't know if you're asking me to go first, but in terms of, are you asking just generally in terms of the valuation profession and sort of the impact? Yeah, I mean, look, I think we play a significant role, and value is at the center of every financial transaction, and so I think that as a result of that, the need for our services will always be there. Maybe it changes because of regulatory requirements on the accounting side or the tax side, but in the end, I think that the skill set that we all have is extremely important, and whether it's informally, at a gathering, family gathering, professional, or with clients, what I find is that the skill set as a valuation specialist we bring is unique and helpful to the overall process, and so I'm optimistic. I think that there is a strong requirement for the skill set that we bring to the market. And quite frankly, in a market like this, despite the issues that we all may have and the uncertainties that we all may have with coming up with value, but still extremely valuable to the overall process.
So, Rajeev, what's your thought on the valuation framework in India? It has been changing over the past few years. In terms of an unregulated profession to something which is getting regulated. What's your take on that?
Ravishu, so we had a situation where the whole market was extremely unregulated. It was completely free for all. Anyone can do valuation, and anyone, any kind of valuation, and they were not held to account whether they do right work or they not do right work. And the profession was largely fragmented. There were thousands of professionals. So now government lately and belatedly has realized that they need to regulate it. But now once they started and looking at it, they realized that it was complete free for all. Now they are trying to tighten the screw to a complete different side of the pendulum. So pendulum has swung from one extreme to the another extreme, and somehow our set of regulators have a feeling that a lot of blame should lie with the valuation community for all the ills of the things which were not going. So they are trying to significantly tighten the process. Now, there are multiple angles to it. One is that, yes, professional risk would increase for all of us as valuation professionals, because there will be first a higher degree of accountability. So we will be called to question about what's not happening right, why it is not happening right. And more importantly, the justice or the so-called justice will be very swift, because the whole administrative mechanism is with that regulator. So it is not that it will go to a court and it will get challenged and the decision will come after 5 years. The decision or any challenge or any adverse action that valuers would face would happen in 6 months. So there will be a speed of action. Whether it is right or wrong is for the market to take. It is anyone's guess. And there will be, because the world is so interconnected, any adverse action would have a lot of interconnected domino effect. So valuers, to that extent, while there is professional risk also involved, there is a huge deal of reputational risk and business risk, because one small challenge could lead you to a lot of domino effect. There would be a professional risk, there would be a business risk, and reputational risk. So, though one is that there is a higher degree of risk, and secondly, there is a speed of action. So if you look at our regulated, so I think the environment around the practice has changed drastically, and there is this draft act also which is likely to come up. The whole the way the profession is structured would be very different going forward. That's fine.
Yeah, Rajeev, I think it might be interesting to look at how these sorts of issues impacted valuations in America, but also around the world historically. And I would say over the last 10 years or so in the U.S., we've been undergoing much more. The SEC has come out and asked valuation professionals to reduce diversity in practice, to try and be more consistent, and I think we've been doing that. But I think sometimes there's a misunderstanding that valuation is not accounting. There is some element of art that's associated with valuation, and the stock market changes every day, every minute, in fact, every second of the day, the stock market is changing. And so, maybe to your point earlier that, people in India are saying, well, you're the expert, you come up with the value. Well, it's not as though you can say, the value is X and not 90% of X or 101% of X. I mean, there is some element of art that's involved here, and again, realistically, the market is changing every day, every minute, and every second of the day. I think also that, and maybe you were facing this in India already, but everybody has an opinion on value. It doesn't matter if you're a valuation professional or not. Regardless of who you are, you have an opinion, and people are willing to share that opinion on value. And so I think that having more structure, having more discipline around the valuation process is helpful. I think that's helpful to everybody, including to us. Having said that, though, I think you can move to a range where it's too structured. You get to the point where you remove the art, and that's not realistic, because again, the markets are changing all the time, and we've seen that in America, but we've also seen in other parts of the world where you become so highly structured in how you do valuations that actually the valuations don't make sense, and that's not appropriate either. And so it's there's a balance that needs to be there between structure, between art and science, in order to make this successful.
Peter, what's the regulatory framework for valuation professional in US? Is it a self-regulation, or is there a regulator?
No, it's self-regulation. But as we move on, there are whether it's the Securities Exchange Commission, the the public company oversight board, and others that have input, let's just say, into how well the valuation professional is working. And over time, we've seen that there have been initiatives to add even more framework around that process. There's something recently that we've been working on called the mandatory performance framework. When you're working with public companies, and there's a designation or a credential now called the CEIV relating to that. So it is over time. We like to say in America, it used to be kind of the Wild West, and everybody doing sort of as they wished and providing their opinion on things they were even unqualified to provide opinions on, and moving to a process of much more structured, much more disciplined reduction in diversity in practice is what we have seen over time.
And are those regulations applicable only for the valuations of public companies, or they also get also for the private companies?
Well, I think what happens is when you have rules in place, that apply for public companies, they get applied more broadly to other companies as well. And so when you look at guidance, let's say from the SEC or the PCAOB, you're going to then apply that to other companies. But quite frankly, when you look at the mandatory performance framework, it's applicable to all companies. So there is no public-private differentiation. So it's but again, we're self-regulated. So it's a little bit of a difficult question to answer, because clearly with a public company, you're going to have more risk, and so you're going to see more scrutiny internally. You're going to see more scrutiny from the auditors and other stakeholders. But in many ways, those same principles apply to private companies as well, especially the big private companies.
Sure. So, Raju, this question for you in terms of how do you see the consolidation of valuation profession, maybe particular reference with India, given the change in the regulatory scenario and the regulatory framework?
Ravishu, difficult question. But if I were to maybe do a crystal gazing, if I look at countries in Australia or Europe or US, which are developed, more advanced markets, the valuation profession has migrated in hands of more stronger, more structured players, because as risk increases, there will be need for systems and processes. There will be need for more stronger management of the valuation process, and maybe smaller or individual firms will have to come together to achieve that goal. Even the institutional clients who prefer to deal with large, more structured organizations, who have more systems and processes and more ability to invest in technology. So if you look at Australia back to, or New Zealand, or you look at even UK and maybe in some parts of US, the largely fragmented appraisal community, the real estate community has been largely consolidated. It has moved into hands of larger and larger players. I was speaking to one of my friends in Australia, and earlier, I'm just talking about the retail end of things. So the banks used to ask for $1 million as professional liability insurance. And all of a sudden they said, no, we need now $100 million of professional liability insurance. Now, none of them are in a position to get $100 million of professional liability insurance. So eventually they will have to consolidate. And this may happen not today, but it may take 10 years, maybe take 12 years, may take 15 years. But I think eventually that would happen. And even if you look at financial valuation profession, the need for investing in database, technology, machine learning, all kinds of technology will force more consolidation, in my personal view. Having said so, there is a market is large enough for every kind of. I think personally that's my view, that it would move towards that direction. he said, so the markets are large enough for every price point and every level of firm, and all of them would survive. Yeah. Any takes on with you, Peter?
What's your
Yeah,
take on that, Vijay?
it's a very interesting question, because I think what we have seen here is that I agree with you, Rajeev, in terms of the way the market is going, the investment in technologies, data, and other things, that consolidation seems like a natural path. But I will also say that in many ways, every time we see a situation like this where maybe people are being furloughed or laid off or lose their job, we see a lot of new firms start up, and so there's this constant cycle of consolidation, deconsolidation, restart, new firms starting. But I think what I view is there's a very big difference between firms of your size or our size and those that are less than 20 people. Now, we may compete with them from time to time, but the depth that you have, the availability of resources, that's very difficult in a group that's got fewer than 20 individuals, and so oftentimes what I find is you hit a time period where you want to invest, you need more depth, you want bigger clients, and seems like a natural time to consolidate with somebody else in your industry so that you can have access to those resources.
I also prefer to add, Ravishu, so there is professional services markets are always passing through, as PJ said, a phase of consolidation, and at the same time, there is one more force, if I can say, which is shaping our profession, which is the knowledge today is quite democratized. If I say 20 years back or 15 years back, purchase price allocation was a fancy word. And if I threw PPA as a word, people would be in awe of me. Oh, he knows what is purchase price allocation. Today, I mean, this is an elementary thing. So valuation has become so democratized and so overused that everyone in India, we say that even our local shop panwala would have a view on valuation. So the knowledge has become so all pervasive that valuation processes have become very, very simple and very widely known. Even complex valuation models, a Black-Scholes or a DCF, there are 1,000 websites which will teach you, and even a graduate coming out of college can call himself a sort of at least expert in running that model. So there is a constant, what I call a force of degradation which is happening because of the democratization of knowledge. The knowledge is so widely and so freely available that the firms, large firms, have to constantly try to differentiate themselves. So while there will be consolidation, but consolidation will only happen if there is a relentless differentiation. They will have to continue to focus on those. Otherwise, it becomes difficult for them to survive because knowledge is so pervasive. It is so easily available. See, all these webinars and lectures and webinar series and so much video being available, so much models being available online. If you look at LinkedIn, there are 1 billion people who teach valuations. How many have done actual valuations? That's a different thing altogether. So while the knowledge is quite open, how to apply that knowledge is a question of experience. And whether the firm, there is a whole set of people can come together and continuously differentiate ourselves and get a message right across to the market, that's quite a different ballgame altogether. So the forces of consolidation, at the same time, they will be substantiated only with the forces of differentiation. So there will be a relentless differentiation required for every firm if they want to make a mark of their own. That's my opinion.
Yeah, Rajeev, I would just add, I agree with what you're saying completely, and I would also add though that there's the democratization of information. And so whether you look at Cap IQ or FactSet or other, that's available today to everybody, and it's not that expensive. So that's helpful, I think, in getting smaller groups or even an individual up and running and having efficiencies that big firms have. And and I would say in terms of differentiation, one of the things that we find is the differentiator for us is data. And I don't mean data that's in Cap IQ or anything like that. It's given the number of transactions that we work on, the number of investments that we value annually, we have access to data that just about nobody else has, and so that data is super valuable.
I agree with you, because see, as firms do more and more work, they kind of build a sort of a barrier. They go along, they continue to build that barrier, and if they are able to scale that barrier higher and higher, there would be some sort of value addition. And also good quality firms would require to position themselves appropriately in front of the client, not just be an expert to be seen as an expert. That is also critical. So, I mean, these are some of the thoughts. Ravishu, over to you.
So, PJ, the artificial intelligence, machine learning, algorithms, how do you see they affecting the valuation profession? I mean, will it become redundant?
Ravishu, you have
So yeah, look, I think that AI and machine learning can help, with some of the tasks and processes that we all do. And so maybe there's some efficiencies that we get from that, but I don't see it replacing what we do, at least not in the near future. I mean, maybe there's a day in the future where, machines can replace humans, but today, what I see is we think about AI and machine learning is it really supplements what we already do, maybe makes us more efficient, maybe adds to our productivity, but not replacing it.
I think Ravishu, even I'll echo PJ's thought. The two things. One, of course, the modeling will become more and more sophisticated. The mathematics part of things will be very democratic, if I can say. It will be known to everyone. The mathematics of valuation. It is so easy. But the fact that a person like PJ or a person like Ravishu has applied his mind to it, the fact that a person of his experience has affirmed that, a person of your experience has put his reputation online to say, this is the number I will go with, that is of immense value. So market actually is not looking for a mathematical model-based valuation. Market is looking for a person of repute saying so that everyone else can trust it. So if PJ says or Ravishu says or someone else says or myself, anyone says, market actually is looking at the face of the person and his credibility that yes, this has been reviewed, accepted, authorized, and approved by this person. So while at the lower end of the spectrum, there will be a lot of democratization which is happening, and maybe real estate valuation for per se, because it is so much data dependent, that it will have a larger impact of AI, machine learning, more what we call computer assisted valuations. But when it comes to more complex work, I believe people would still come to us. So I think in our lifetime we are safe.
So that's good to have a thought on that.
I would add, just in a market like this, I think your judgment and my judgment becomes even more important. When you look, there's so many moving pieces, and I think it becomes even more valuable at times like this.
Yeah, please.
In conclusion, any thoughts from your side, PJ, in terms of valuation profession evolving over the few years?
Well, I think it's going to continue to evolve. What we have seen, in some ways surprising, over the last 20 or even 25 years is, I think Rajeev mentioned, I chair a group called the Appraisal Issues Task Force. We meet 3 times a year, and you might think, why do you need to meet 3 times a year? But our meetings today are, just as strongly attended as they were 20 years ago, and because things continue to change, and the regulatory environment changes. I think best practices change. We've tried to reduce diversity in practice. We're trying to be smarter about things, and so I think we continue to change, we continue to learn, and that'll continue going forward.
Rajeev, your thoughts on that in terms of valuation profession developing over the next few years?
I think for a country like India, it's a sunrise profession still. It's very much a sunrise profession. It is very early and nascent stage. But people who will be able to take advantage of that profession would be people who do it with a sense of purpose. They will have to invest because regulatory risk is going to increase. There will be more oversight of valuations. So people will have to be risk averse and do it right. And if they do it with a sense of purpose, do a lot of focused work on that, I'm sure we are in a very, very early stage. And no matter what all this regulation changes are actually happening, I believe that is very good. That will increase the fee. That's a burning problem for all valuation professionals, because a higher risk will always go with a higher fee. And every person would need more time to do his work. He will try to do his work more thoroughly, and eventually market would adjust to the new normal. And I think it would weed out some of the most scrupulous players, because they will be in that sense more fearful of the regulatory action. So I think we are in very, very nascent market at the moment, and the way the economy would look up in the next, if I say next 10 years, these are the best 10 years for valuation profession, in my personal view. The next 10 years are the best 10. That's fine.
Excellent. Excellent. I think we'll try and maybe take a few questions from the audience.
Yes, please. Nitin, can I request if you would like to maybe lead a few questions that you received?
Yes, I mean, we have on the right-hand side, there is a section on questions. So, I mean, audience and participants can put in their question. In the meantime, I have few questions here, but it seems that several of them have been answered. For example, there was this question in relation to what should valuers do in respect of valuation report issued just before the pandemic broke out and lockdown started. Should we withdraw those reports? I mean, if someone among you wants to respond to this question.
But my take on that, you issue a report on a particular day with a particular valuation date, and you take into account the circumstances which are existing on the valuation date, and knowable at that particular point in time. It is valid on the date of the issue. That's how I would look at it. If the subsequent circumstances changes, I mean, I don't see a need to take back the report or withdraw the report unless there is some other inherent mistakes or apparent mistakes which might have been there. Any take from you, PG, Rajeev?
I agree completely. I think when we talk about valuation dates, the regulatory bodies here refer to this as contemporaneous valuation. So the valuation as of the date, there's nothing better than that, regardless of what circumstances may have changed after that date. I agree with you completely.
So my take there is that I'll be more worried about the valuations that I'm doing after the pandemic than before the pandemic, because pandemic has given me a wonderful excuse of why they are wrong. About what I will do after the pandemic.
Fair play, Rajeev. Fair play.
Then there's a question on risk premiums. So there's a gentleman asking that equity cost of equity is comprising of two elements. One is basically influenced by the risk-free rate, and another is influenced by the equity risk premium, and both of them are moving in divergent directions. Risk-free rates are coming down and equity risk premiums are going up. So what happens to the cost of capital, cost of equity in this situation?
But I can speak on my end. I mean, what we're seeing is right. Risk-free rates are going down, equity risk premiums are going up. But I think cost of equity, I think we would look at it and say cost of equity is increased. Risk is increased, and so I think when you think about where the cost of equity is today versus where it was 6 months ago, you would expect it to be higher. And I think based on the market indications that I'm seeing right now, it's got to be at least, somewhere in the 50 to 100 basis points higher, if not even higher than that.
Yes. So there is a whole divergence thing, PJ, that the risk-free rate is going down every day. Now, how do you account for that? And when the risk is actually is increasing, so what you are doing in your practice? Can you be a little more specific?
Sure, yeah. So let me step back, because I think many of the discussions we're having around the cost of equity, the risk-free rate, the market risk premium, and actually the overall weighted average cost of capital go back to the Great Recession, 2008, 2009 time period. And so when we talk about the risk-free rate, we've thought about whether that should be a spot rate or an average rate. And today what we have decided is that really it's a spot rate. It's the one thing we can look to the market, and on any given day we know what that rate is at. And I think that in the past we've thought about maybe doing some sort of average, but today I think we can look to the market and say we know what the risk-free rate is. Now the risk-free rate is subject to so much impact from the government and the monetary policy, and it's very difficult. So in the US, what we have seen is the long-term risk-free rate runs about 2.5%. Today it's 1.5%. And so that difference between the long-term risk-free rate and the spot rate today, in our view, should be added in as additional risk premium. That should be an additional factor, whether you include it in the equity risk premium or as a separate ARP. In terms of the equity risk premium, I think it's difficult. There's so many studies out there, and Professor DeModern does such a fantastic job of calculating a monthly ERP or market risk premium. And we've seen the range from nearly 5 to 6%. And over a short period of time earlier this year, maybe a little bit higher than that. But again, I think the equity risk premium has increased. I think there is more risk in the market. Qualitatively, I think we know that there's more risk in the market. But on any given day, given where the market is at, we may find that premium is lower, just because of some of the items that we mentioned earlier in terms of liquidity in the market and things of that sort. The final item that we hear about frequently from our clients, and probably more during the Great Recession than today, is that with equity prices declining, the split between debt and equity is now skewed more towards debt in calculating the weighted average cost of capital. And if you leave everything else the same, what that would do is actually would reduce your weighted average cost of capital. But again, that doesn't make sense. Again, you have to balance that with, ask yourself, is there more risk today or less risk today? And clearly there's more risk today than there was 6 months ago. And so I think from that standpoint, what we're seeing is that, risk has increased, discount rates have increased. And so you really need to factor that in. And I know, Rajeev, there was another question, I forget the exact, as we were preparing, we had also talked about, maybe higher, how do you calculate the, discount rates? And, the one point that I wanted to make is that, in the end, when you're calculating discount rates, you could also look at them as a probability factor. And again, the probability of receiving those cash flows is maybe a little bit lower today than it was, in the past. And so that's another way to think about it, as you're trying to come up with the appropriate discount rate.
Thank you.
There is
Yes.
There is an interesting question on what kind of caveats and limitations that we put in our report, given the current uncertainty. Additional caveats and limitations in our valuation report.
Ravishu, you want to take that?
I think from our perspective, we usually would bring it out the greater uncertainties under which the evaluation is being performed, and the value divergence could be a bit higher as compared to what typically as a valuer we would have looked at, and basically make it categorically clear that these valuations could change with the passage of time. And that change could be significant given the level of uncertainties you are living in. Your take on that, PJ?
It's the same, and what I would say is those are all standard parts of our assumptions and limiting conditions. They're just more relevant today than they were 6 months ago or a year ago.
Then there is a question on MNC's valuation. This is with the Indian context. Generally, MNCs in India, they basically sell at a premium. Now we have this deglobalization thing that has been discussed, a very hot subject of discussion. What happens to the premium to these MNC valuations?
So you're saying the likes of the Unilever and the Lupe, the large foreign companies which are listed in India, their valuations?
Yes.
Of the world and the Unilevers of the world.
So we are talking about, they're talking about the holding company. In India, we see that MNCs enjoy premiums in valuation because of their international presence. Now, because of the deglobalization, which has been heatedly discussed, will the holding company premiums vanish?
Maybe I'll try and attempt it, and maybe so.
Yes, please.
If you're looking at I'll split it into two parts. One is in terms of if you're looking at the subsidiaries of the multinational companies operating in India, they certainly get a premium as compared to maybe many of the local peers. And that premium, you would be able to witness it over a longer period. I mean, be it in current times or be it 3 years back or 5 years back or 7 years back. So it's consistent that the market has given those companies a premium as compared to their maybe the domestic peers. And then if you try and analyze that, what's a reason for market giving a premium to those companies? And it's not a matter of a month or 2 months. It's been consistently at a premium, and typically market cannot be, as a valuer, we cannot assume that the market is consistently wrong over a longer period. And then if you try and analyze the reasons, what we feel usually is that is because of their strong support from the parent, be it in the form of the technology or the brand, strong processes which they have in India for the manufacturing, the standards which they have created, the distribution network which they have created, which at the end of the day, if one is looking from a risk profile perspective, it essentially reduces the investors' risk of investing in those companies as compared to some of the other companies. The way I would look at it is there is a reason for which the market is paying a premium for those companies, and that reason doesn't vanish purely because of deglobalization, because those companies inherently perform and have a presence in India. I mean, your take on that, PJ?
Yeah, I don't know a whole lot about these kinds of companies, but what I would say is, just going back to the fundamentals of valuation, it's about cash flow and discount rate, and so if you can expect higher cash flow and have lower risk, that's going to mean more value. So to me, it's always good to go back to the fundamentals on these types of issues.
Then there is a question on this is pertaining to tangible fixed asset valuation. The question is that how do we do inspection of factories and industries, and without inspection, how do we value these assets?
Well, it's difficult here. We'll have to wait for, there are multiple ways. I mean, either we wait it out, let the COVID pandemic pass and wait for 2-3 months and wait for some time to emerge, where you could easily go there and maybe do all your physical inspections. The other way could be doing a more of a constructive inspection by looking at the photographs and all, but then you will have to clearly explain that in your report that it is not a proper physical inspection. The third is, if you have valued that in the past, then you could maybe, based on certain assumptions, you could do it again. But there are no right answers. People are trying various technology solutions. You could use a direct videography, someone streaming it to you and someone doing inspection on your behalf. People are trying multiple things because this COVID will last longer than what we anticipate. So yeah, some sort of technology coming to our rescue. I think Ravishu, it's time, and if I can, maybe try to wind it up with your permission. I think it's a very interesting conversation, PJ and Ravishu. A pleasure. Now, I think at least I can say with a lot of more confidence, and all the people in the audience and all the delegates would also agree with my statement, that why I will go to war with both of you, because I will have the best people to defend me so far as valuation is concerned. So it's a pleasure, PJ and Ravishu. Thank you very much. Both of you have been dear friends and partners, and I would love to have more such conversations with you. Thank you very much for your time. Thank you.
Thank you as well, Rajeev. Really enjoyed it. Ravishu, great presenting with you as well. Thank you.
Thank you, PJ and Raju. Thank you very much.
Thank you. With this, I'll request if we can close this session. Thank you very much, PJ and Ravishu, once again. And thank you all our participants for your patient hearing. Thank you.